We're going to get the CPI inflation report on the 11th next week, on Wednesday. It's expected to tick up. Touched on it briefly in my last update. I'll link that at the end of this video. Talked about what I'm expecting for the stock market in my last video. I want to touch on a few other things that are related to that in this video. Now, we've already had recession warning signs. Just got the jobs report. It's still holding strong. You got people on the internet still saying, oh, this meeting, the Fed's going to start cutting. Other central banks are already cutting. We're going to see the Fed cut. Ain't going to happen. The jobs report came in. There's no reason for the Fed to cut. They didn't panic at the April bottom. There's no reason for them to panic at the moment. Could it be that the uptick inflation gives us the pullback for wave 2? I'm going to talk to you about something I've been thinking through. Run it up the flagpole and see which way it blows. Show you and see what you think about it. So watch a video here all the way through. I have something really interesting to share with you. I don't know if it's correct, but I want to show you thing that I've been thinking through. Now, I've noticed that the red here is the CPI, first of all. The blue is the unemployment rate. And again, we're coming off of the lows. The unemployment rate you tend to have at the bottom, you tend to have this rounding bottom over and over again just before the recession. The unemployment rate should be at a lower level, but you tend to get this rounding bottom just before the recession starts or going into it. You start seeing the unemployment rate tick back up. You start losing jobs. No, there's already deterioration in the labor market. We know that there are fewer jobs created in 2024 than in 2023. So we're already seeing the deterioration in the labor market. And then over here, again, another rounding bottom over here. It's a self-imposed shutdown of the economy. But you can see the rounding bottom before the recession that started in late 2007, December there. The recession going into 2001 here. Again, a rounding bottom. This is what we're seeing right now. We're seeing a rounding bottom. Unemployment rate starting to tick up. And that we're at 4.2. It's still relatively low. But you tend to see the unemployment rate reach a low and then begin to move up off of those lows, get a rounding kind of a bottom right before the recession. And that's what we're seeing right now. Now, we've seen the inflation come down. It was up here at 9%. Remember, as we were in 2021 and inflation was soaring, this is the CPI. Look at it, soaring right here. In 2021, the Fed's telling us, inflation is transitory. They were so dovish, they weren't hawkish. But now that we've had it go down, now the Fed is extremely hawkish, concerned about inflation over here. Now it's transitory, no concern, very dovish. And now the Fed is super hawkish on inflation. They should have been hawkish back over here. Now they should be dovish because we're about to move into recession. It's just the Fed doesn't believe that because they believe in their soft landing nonsense. That is a myth. When we turn back up, and that will be blamed on the tariffs, don't think inflation is going back to 9%, but I think it will tick back up. Right now, it's at a 4-year low. I've said I think either this report or going forward, you're going to begin to see it go back up. I believe it's going to be this report. Now, I could be wrong, and consensus is it is going to tick back up with the economists. And I think you're going to, as I've said last month, when we hit that new low, I told you I thought we'd turn back up at some point, and that would probably give us our wave 2 pullback. I still think that, and I think that this report right here, we get next week, and then we get the Fed meeting a week later. Again, that could create some volatility in the stock market. We may not see it immediately with the CPI. Great Scott, did you hear what I said? We may not see it immediately with the CPI. The market may shrug it off. Fed, if we start seeing inflation tick back up at the CPI and other inflation reports, we'll get the PPI wholesale inflation next week. The Fed, at the next meeting that we're going to get a week and a half from now, could be very concerned. And that's what Powell's been saying. But, I mean, he could be hawkish. You've got the president out there calling for the Fed to lower rates. The Fed is scared of Trump's tariffs. Going to cause this inflation. And if that were true, then why aren't all these other countries that have massive tariffs? Why don't they have hyperinflation? Makes absolutely no sense. But regardless, the Fed believes that, okay? And the market talked about an inflation freakout, and I do believe inflation is going to tick back up based on history. And right now, the money supply is starting to tick back up. That's what causes inflation to increase, and I think we'll see inflation tick back up. I don't think it'll make a new high, but I think it will go back up, and I think we'll begin to see yields, and this is what I want to talk to you about. I think we're going to see yields make a new high. I'm starting to become convinced that that's probably going to be the case. I think that that could lead to an inflation freakout. I think a couple things are coming down the pike that are going to freak the market out. I think tensions in the Middle East are going to freak the market out. You know, Jamie Dimon is running around talking about a crack in the bond market. That's going to be proven correct. I think you're going to begin to yields go higher, and eventually the market's going to go higher, but eventually that's going to create an inflation freakout when we start seeing the CPI and other inflation, the PCE and the producer price index, other gauges of inflation begin to rise back up. And that's usually what happens with the recession. Now, back over here in 2007, we saw just before the recession hit. The recession hit in December of 2007. The Fed was, inflation was higher than it is right now. The Fed was, freaking out. They are right now about inflation. It was much higher back then, but they were telling us that we were going to have a soft landing. No worry about recession, but they were sure worried about inflation. Inflation went higher, but yet the Fed still did jumbo cuts in January of 2008. We started the recession in December of 2007, and inflation kept going higher, yet the Fed still cut. The narrative is that as inflation goes higher, the Fed can't cut, and that's simply not true. Historically, we've seen the Fed cuts happen associated, for the most part, with the recession. Right before the recession, you're going to get the unemployment rate starting to tick back up here in blue. You're going to get the inflation starting to tick back up. Look at over here in 2007. Unemployment rate started ticking back up. We entered a recession, inflation, and it kept going. It kept going for 10 more months into the recession, and the Fed was doing jumbo cuts. People, I post on social media, I talked about about the Fed eventually doing jumbo cuts, inflation rising, and people were scoffing and laughing at me, saying, "Oh, the Fed can't cut if there's inflation." Well, this chart says the opposite. Right here, the inflation was rising. The Fed did jumbo cuts. The Fed panicked. Stock market began to crash. Inflation rise, and the Fed, even though inflation was sharply rising, the Fed still did jumbo cuts in January of 2008. Emergency rate cut, and it was a jumbo cut. And 2 weeks later, at the meeting in January, they cut again. Slashing rates, even though inflation was rising. And you're going to see the same thing happen here. So I think you're going to see, historically, and look right here, inflation rising just before the recession. Inflation elevated here, pulling back, and then rising just a little bit here, going into the recession. Then it fell over here, then it fell. Deflationary bust, deflationary bust. Going into the recession, it was rising, kind of stalled, and then rose as we moved into the recession even further, into the 90s there, and then the deflationary bust. Over here, inflation sharply rising there. Remember, this is when they were raising rates to high levels to deal with the inflation of the 1970s. Volcker was doing that, but we saw inflation right here going into that recession here, and then we had back-to-back recessions. Unemployment rate spiked going into it, calmed down, and then another recession immediately followed. Had a deflationary bust. The point I'm trying to make to you is you're going to eventually see the unemployment rate go up. Eventually, you're going to see the negative jobs. Have it yet right now. We're not going to get any rate cuts as we're being told. But eventually, you're going to see the inflation go higher, and the Fed is still going to cut rates. I think that the 10-year yield is going to turn back up. Starting to look that way to me. Talked about an inflation freakout when we get this next move higher with inflation. Could that be the 10-year yield, pushing higher? And Jamie Dimon's right, and we get the bond market cracks. Eventually, the 10-year yield peaks. So does the stock market, and we begin to get both of them moving lower. I'm looking for inflation to turn back up, and I'm going to show you that now. Now, keep this in mind. If we see the yields begin to rise, there could be a tick in the inflation data here. We could see yields rise. And yields rising back up, concerns about the debt. We're going to be getting the tax bill likely getting through probably this summer. Expected right now to pass in July. I don't know if they get it done, but we'll see. Could the market rally on that? Could we pull back in the rally on that? Concerns about the massive government debt. Something to be aware of. I think that the inflation is reaching a bottom here, and I think we are going to turn back up. Eventually, this is going to rise, and I think you'll get an inflation freakout. It will likely give us a top of the market, and that will likely give us a top for the 10-year yield. So if we see inflation begin to tick back up, that will cause yields to rise as investors demand higher yields as inflation begins to rise. Could see the 10-year yield rise to a new high. Inflation tick back up and make a lower high, moving back up. I think it moves to a new high, back up to 9%, but we could see it rise back up. We could see the CPI rise back up. As it does, we can see yields go higher. The bond market begins to price in inflation. As the bond market begins to get concerned about the government debt, that could take the 10-year yield to a new high. Could take the inflation data back up, move into recession. Now, next week we're going to get the CPI data. We're going to get the inflation data on Wednesday the 11th. Again, it's expected on a year-over-year basis to rise 2.5%. The previous year-over-year was 2.3. On the core, it's expected to go to 2.9. The previous reading was 2.8. If inflation is bottoming out with the CPI and begins to turn back up, we can get a pullback, but still eventually go higher. But like I keep saying, this could eventually lead to an inflation freakout. Now, I think we're likely to see an uptick with the 10-year yield. I think we're likely to see an uptick in inflation as we've seen historically before the recession hits. But then you get that deflationary bust, and I think this time will be no different. Rise in inflation will be blamed on the tariffs. What's really going to cause it? The concern about the debt. What, $37 trillion now in the U.S. The interest tab on the debt is nearly $1 trillion a year or so, or take. I think we will end up seeing this crack in the bond market, this bond market meltdown, and I think that the inflation tick back up, and I think we'll see this be one of the catalysts that leads to the stock market top. That could give us a pullback right now. This could be a catalyst right now. Start to see the inflation data tick back up. If we start to see the yields, the 10-year yield resuming the advance, what they're talking about the bond market cracking, treasuries, yields, they move in opposite direction. And investors' confidence that the government is going to be able to repay what they are borrowing, they demand a higher yield, a higher return for their risk. I think the yields are going to get one more pop higher. We're going to see this happen. And this issue could be the catalyst or one of the catalysts that ends up taking the market sharply lower. That's where I think when we get that final peak, I think the Fed will panic. This could give us a pullback right now on concerns about this if we start to see the inflation go higher, concerns about the tariffs, concerns about the debt, and we can see things later give us a rally after the pullback. Trade deals being announced. Maybe they get the tax bill through, and there could be hopes that the tax cuts occur, and it helps money work its way into the stock market. So it could also be that happening, and eventually they pass it, and it could be buy the rumor, sell the news. That's what happened in 2001. George W. Bush ran on the tax cuts. Stock market had already peaked before the election, and to go down. and we had already entered the bear market. At the time Bush signed the tax cuts into law, it was, a buy the rumor, sell the news, and it gave us a counter trend. Certainly possible that it becomes a buy the rumor, sell the news if it drags out, can't get it through. So we'll see what happens. Now, this is on top here, the 10-year Treasury yield. Below, I have the 10-year Treasury note. They move in opposite directions. After years in dropping, we finally saw a bottom with the 10-year yield, and we're pushing higher. Move may not be done yet. If we get one more pop higher, we could see the 10-year note and things like TLT drop down and make new lows. 2020, the yields bottomed out and they have begun rising. The 10-year Treasury note has been falling, moving the opposite direction to one another. And the concern is that investors demand more for the risks that they're taking on, and we end up seeing yields go higher, and we see treasuries, bonds, we see them fall. We recently in 2020 saw the yields, this is a long-term chart in the weekly time frame, saw the bottom, and we're rising back up, and what is likely a wave 1 will pull back in the recession for a wave 2. This is a 10-year yield. What we've seen over the years is the ratcheting down of rates. You see it reflected here with the yield, but that's what we've seen really with the Fed do. The ratcheting down of rates to artificially prop up the economy and prop up the stock market. And then they introduced the QE. The Fed's so worried about the inflation from the tariffs. Well, guess what? QE is inflationary. So is the stimulus checks that we saw with the pandemic. It's all inflationary. Fed should be worried about their policies because their policies cause inflation. They need to look in the mirror if they want to see what is causing inflation. I think we bottomed here. I think we're going to get one more push higher, possibly, and I'm going to show you the chart, see what you think. I'm just running it by you. And again, if we get this crack in the bond market and the yields go higher, seeing the inflation data tick back up, we could eventually see an inflation freakout I talk so much about. I still think that's going to happen when we start seeing the inflation data turn back up. Right now we're at a 4-year low, but it's going to turn back up. Historically it has, just before the recession. Then you get the deflationary bust. Here, I think we're going to push higher and then pull back in an ABC move, maybe to this trend line, maybe to a Fibonacci retracement, whatever, but I think we could pop one more time higher. That could eventually lead to a freak out. I'm going to zero in on this area right here, but this is a long term. This is going back into the 1980s. Yields drop and drop and drop and drop until finally they bottomed out in 2020. It's likely a wave 1 higher. We're probably going to see a wave 2 once this move is done. Now here is TNX. This is the index that represents a 10-year yield. Okay, this is the weekly chart, and I'm just going to run you by this. Maybe I'm way off on this, but I think what Jamie Dimon is saying makes sense. Talking about a while now an inflation freakout. I think we go above 90%, but I think we see the yields begin to rise back up, and eventually, into the summer or fall, that gives us freakout. Here, I've marked a possible Elliott wave count for the 10-year yield weekly time frame. Here's the bottom in 2020. We just saw the long-term chart. B wave 1 not yet completed. Could we have a 1, a 2, this whole thing being a 1, 2, 3, 4, and a 5, completing 3, an extended 3. So you got 1, 2, 3. Then we get an ABC for 4 here, and we're now getting 1 and 2 of the fifth and final wave here. And then we start selling off right now, and we start seeing yields begin to rise. Could that be associated with inflation starting to tick back up? Maybe. Or concerns about the debt. They're passing this bill here, taxes in it, not much spending cuts in it. There are some. Could be more, but Washington's spending $7 trillion a year, and they're running in $5 trillion in tax revenue. They've been doing deficit spending of $2 trillion a year. It was $1 trillion, which was ridiculous. And then that going back to the financial crisis, we had the $1 trillion that they've been running. Before that, it was less than that. Now we have $1 trillion deficits every year. Now we're getting $2 trillion deficits per year. This is unsustainable. This is why I keep telling you the politicians are going to give us a depression. I see it happen likely in the early 2030s. Sustainable what they're doing. Nevertheless, I digress. Could we see the yields pop higher surrounding inflation and then begin to get this ABC move back for the wave 2, pop up higher, complete the fifth wave, and complete this as a wave 1? We get the wave 2, we see a deflationary bust, we see yields come back down out of the stratosphere. Could this be the case? We're going sideways. I'm wondering, are yields going to pop higher here? Start seeing the 10-year note and TLT and the bonds just begin to collapse. Eventually, could produce a severe collapse in the stock market. This could produce a severe collapse in the stock market. Could we have the wave 4 done and starting this 5-leg push higher, end up seeing the yields end up going higher? When this happens, it could rattle markets. But right now, could we begin to get this wave 3, see the market pull back for a wave 2, still moving up together long term, but periods where they have negative correlations, periods where they have positive correlations between the 10-year yield and the S&P 500. We see this push higher, get pulled back, but then eventually, after the pullback with the S&P, the market resumes the advance into the summer or fall, and then eventually there's a day of reckoning, seeing the stock market collapse, and maybe that's when the Fed begins to panic. This could just be months away from happening if this scenario plays out. Now, I'm not certain that we're going to see new highs with the 10-year yield, but again, I'm looking at this, I'm looking at my count, and wow, this looks like a wave 1, 2, 3, and a 4, and okay, where's the wave 5? Or am I wrong? Is the blue wave 3, is that over here, and we get 4, blue wave 4 here, and this is 5, and already peaked, and now we're going to go lower? I don't know. I'm just telling you, again, this count, it has some real possibilities, and it would be in agreement with what Jamie Dimon's saying. This happening, concerns about the debt, the CPI starting to rise back up, concerns about inflation, the Fed's not going to be able to cut rates, probably tensions in the Middle East, concerns about a regional war. All of these things could be the catalyst for pressuring in the next bear market. I think that we're still going to get the blow off top. I think we're in it right now, the final phase of the blow off top. I think that this count very well could be in play. Again, I think we're going to pull back very soon. I think we could peak in the next 8 to 10 days, trading days. This next week with the inflation data, or maybe with the Fed, coming up to my target levels, those trend lines I've been talking about, S&P 500. But could we see further stress in the credit markets? Just the pullback, our way higher, eventually coming up here, and probably another pullback, but eventually you're going to see this thing begin to soar once we see the peak in the market. Could it be we're setting up for real concerns, higher yields and collapsing treasuries? Eventually we're going to make our way. The stress in the credit market have come down. We've rebounded back up, and we've nearly recovered the entire decline, as I told you we would. Still think we're going to pull back eventually, and then again eventually make our way up here, and after that it begins to peak and we start pricing in the recession. We're going to start seeing the stress in the credit markets soar even higher, and again at some point that's when you're going to see the stock market begin to collapse and begin to panic. No matter how high inflation's ticking back up, the Fed's still going to do jumbo cuts, and they're still going to panic. That's going to be on into the summer or fall. But the bear markets, 2007, 8, and 9 there, 2000 to 2002, it's been associated with stress in the credit markets, a financial crisis, subprime mortgage crisis, the bursting of the tech bubble, the 9/11 attacks, associated with stress in the credit markets. even some of these other issues that I've marked here on the chart. We're going to make our way higher, and then this massive increase stress in the credit markets. But like I said, I think we're getting the rally. I told you the rally of hope that was going to happen. We're getting that. We're going to get a pullback, and then I still think we're going to go higher. I think we're going to top and crash. I think the Fed will panic. It always is. As a 10-year yield, I think it's already completed this 4, ABC move for blue 4 here. I think you've got 1 and 2. I think we're about to complete 1 on the S&P and NASDAQ and Bitcoin and pull back and get 2. And then I think we get 3, 4, and 5. I think right now we're about to get the 3 with the 10-year yield if this ends up happening. And I think, but it's been something I've been thinking about, playing around with this count right here and trying to figure this out as we've gone really sideways. This has some real possibilities. You see yields surge back up. We begin to, the market sell off. Yields come back down. The market rebounds, gets a wave 3, 4, and 5. They could end up both completing this final 5th wave right here. Here I've marked this as the blue wave 5 right there. Complete the wave 1 here for the 10-year yield. They've been rising longer term, positive correlation. They could fall together. That's why I'm saying you'll end up getting this deflationary bust. I've talked about the S&P going a little bit higher, NASDAQ going a little bit higher, maybe towards this trend line right here from the previous highs, but then pulling back. Could yields end up popping higher, concern the market? Could the inflation data start rising? Could that concern the market? So just some things to ponder as we have potentially a wave 2 that's coming, the S&P for the NASDAQ and for Bitcoin. Do we get a rally if the yields start coming back down after rising? Or do we rally maybe with the tax bill getting passed or trade deals being announced, whatever the catalyst may be? But I'm just telling you, this is what I'm looking at. I think you can rally up here, but then I think you're going to pull back on the S&P. Like I said, we may fail to reach that trend lines. NASDAQ's going to reach it. S&P is a little bit further away from it, but I think you're going to see a peak here as we move towards that area, and that could be going into next week of the Fed. Within the next 2 weeks, we could see this pop and the pullback begin, and this is a more shallow retracement. It may be deeper. P500 has bounced off major support, this trend line from 2020, and again, it's been rising since that 2020 low, just like the 10-year yield. Periods of positive and negative correlation, but longer term they're rising. I think we're moving to get this 5-leg push higher. I think we're about to complete wave 1 and then get wave 2. I think that we've got 1 and 2 on the 10-year yield I've shown you. The bears are telling us we're going to crash here and this rally is never going to happen. They got real problems because, again, you're bouncing off major support, horizontal support, rising trend line of support, just above our 200-week moving average here in the weekly time frame. Possibly going to take us to this upper boundary or the channel. Be very close to this area in the monthly time frame, the long-term channel going all the way back to the 2009 low. I think could very well be the case, and this is it right here. Again, we have a bottoming tail at our 50-month moving average, at our 200-week in the weekly, and again, we could be on our way, pulling back and then coming up back up, going in to this trend line right here. And this is where we had the 2022 top. This marked some of these other turning points, 2011 after we had the 2010 peak, 2011, 2014 and 15 there, 2022. Could that mark a top? I think that's very likely. I'll show you the MACD here. I think the S&P is going to push up a little higher into the trend line I've been talking about, the trend line from the previous highs, or at least come close to it. I think we're going to make an attempt to get closer to it or tag it. And I think that this MACD is going to end up turning back up. But I'm making it real big so you can see it here. We're not turning back up yet. We're under it. And this is likely going to get back above the signal line and come back up here. And you're probably going to see a move closer to that trend line and end up forming a divergence. I told you, I thought the put to call ratio would fall back down. It is. This is the 5-day moving average. I think it's falling back down here. And I think you'll end up coming back up closer to this trend line, and you could see this divergence develop here where price goes higher on the S&P and we get a higher low with the 5-day moving average, and then you start seeing this pullback, this bigger pullback for the inverse head and shoulders. And maybe it's deeper, maybe it's not so deep, maybe it's more shallow like this, but a good shot at this inverse head and shoulders pattern playing out, even if it's unbalanced and you get a deeper retracement. But this is what I thought was going to happen. It looks to be playing out. I think stocks above their 20-day moving average will come back up here and end up forming a divergence. We saw this extreme reach and we saw a pullback. We're going to new highs, and so far we're not making new highs here. New highs here on the stocks above their 20-day moving average on the S&P. I think it comes back up to the 75 area or just beyond it, and you end up getting a divergence. And I do think you're going to see multiple point divergences like what we had over here end up taking us to much higher levels eventually. But I think we will get a pullback. I think that's likely going to be with the divergence here. We see something like this where we see this push up towards this trend line, or maybe tagging it a pullback for a 2 and a right shoulder, and then a wave 3, a 4, and a 5 into September, October. I've drawn the example going into early September. Do rising yields or rising CPI inflation, does that start kind of pullback, or does it give us the rally and then we start pulling back with the Fed or something, or yields rising maybe closer to the Fed meeting? We'll see what happens, but again, I do think we're going to go higher, but then I think we're going to stall in this area.